completely shatter the illusion of retail investing. We're kicking things off with a massive study from the Securities and Exchange Board of India. And honestly, this research absolutely shook the financial world. They looked at 10 years of trading data across millions of retail investors in the futures and options market. And what they found in that massive data set? Well, it's something literally every single person putting money into the market needs to hear.
Just let this number sink in for a second. Out of all those millions of active retail traders over a 10-year stretch, only 9 out of 100 actually turned a profit. 9%. That means the other 91% lost money. And we're not just talking pennies. In many cases, it was significant wealth. But here is the craziest part about that number. Most of those losing traders, they weren't just unlucky passive bystanders. They were incredibly active. They were glued to charts, chasing hot tips, making constant decisions. They were doing everything they thought investing was supposed to be, and they were still losing.
Now, what's really fascinating here is a recent University of California study that essentially proves all that activity is not an advantage. In fact, it's actually your biggest liability. The researchers analyzed the trading records of 66,000 individual investors over 6 years. And get this, the most active traders, the ones constantly tweaking their portfolios and making moves, they underperformed the broader market by a massive 11.4% every single year. Meanwhile, the investors who traded the least, the ones who basically just sat on their hands and did nothing, they came the absolute closest to matching overall market returns.
So why on earth does this happen? Well, the 90% who lose money, they aren't stupid. They are just human beings acting on deeply ingrained natural instincts that, unfortunately, consistently destroy returns in the stock market. It's the whole foundation of behavioral finance. The things that feel completely right to our brains, like jumping on the bandwagon when a stock is shooting up, or selling in a panic to avoid pain when things drop, those are exactly the behaviors that wipe out wealth at scale. You see, we're operating in a system our brains just weren't built for. We're wired to run away from saber-toothed tigers, right? Not to navigate market volatility.
All right, Section 1, the 3 fatal investing mistakes and why your brain is working against your portfolio.
And this brings us straight to mistake number 1, buying the hype and selling the fear. The Dalbar report tracks what they call the behavior gap, and it's huge, a full 2%. Over a 20-year period, the average fund returned 5.6% annually. But the average investor holding those exact same funds, they only took home 3.6%. And no, that gap isn't from hidden fees. It is caused entirely by people panic selling at the absolute bottom when things look bleak and FOMO buying at the very top when the hype is totally deafening. Over 30 years on just a $10,000 investment, that psychological glitch costs you over $30,000.
For a textbook example of this, we just have to look back at the 2020 to 2022 crypto cycle. The highest volume of retail investors piled in right near the peak. They got sucked in by the constant media noise, all the social media flexing, and that terrifying feeling that they were missing out on a sure thing. But when the price eventually collapsed back under $17,000, all that excitement instantly turned into fear. A huge majority of those retail investors sold at a massive loss, essentially crystallizing their terrible emotional timing. The asset eventually recovered, but their portfolios didn't.
Okay, mistake number 2, overtrading. Confusing activity with actual progress leaves you wide open to 4 hidden costs that silently eat away at your wealth. First off, transaction fees. They compound against you over time. Second, you are operating at a massive information disadvantage. By the time you read a headline, Wall Street algorithms have already priced it in. Then you've got short-term capital gains taxes taking a bite out of any profits. But the absolute biggest killer? The psychological load. Constant active trading means you're experiencing completely normal, everyday market volatility as a daily, deeply personal threat, which inevitably triggers irrational decisions.
Just to put a concrete number on that psychological load, researchers Odeon and Barber found that in the exact same market conditions, patient investors practically crushed the hyperactive ones. The most frequent traders earned just 7.1% annually, but the least frequent traders, they brought in a massive 18.5%. It's wild. The harder they tried to force a profit by moving money around, the worse their returns actually got.
Which naturally leads us to mistake number 3, having no exit strategy. If you jump into a trade without a predefined plan, you are leaving yourself completely at the mercy of the endowment effect. Basically, this is a psychological glitch where you value something way more highly simply because it's yours. And hey, I've absolutely been guilty of this myself. Combine that with loss aversion, the reality that losing money hurts our brains twice as much as making money feels good, and you end up holding on to losing positions way longer than makes any logical sense, just blindly hoping for a bounce back that might never come. You see, the greatest investors in the world don't have a crystal ball. They don't magically pick only winners. Instead, they relentlessly followed predetermined exit strategies so they can cut their losers quickly, which honors Warren Buffett's famous 2 rules of investing. They literally decide what their maximum acceptable loss is before they ever buy the asset. So when the market inevitably tests them, they just execute the plan mechanically. It completely short-circuits that emotional endowment effect before it even has a chance to kick in.
So let's move on to Section 2, the 3 habits of consistent winners. This is the unglamorous system of the 10%.
Habit number 1 is defining your risk before your reward by using strict position sizing. This guarantees that a streak of bad trades, which is totally inevitable by the way, is completely survivable. Professional fund managers rarely risk more than 1 to 2% of their entire portfolio on any single idea. If they're wrong, it's just a flesh wound. But retail investors, we tend to do the exact opposite. We concentrate our capital into a few high-conviction trades because it feels like we have an edge. Spoiler alert, we don't. And that concentration is exactly how small, manageable mistakes turn into catastrophic, account-wiping losses.
Habit number 2 is staying strictly within what Warren Buffett calls your circle of competence. This is what stops you from speculating on some complex, narrative-driven hype train that you don't actually understand. Think about it. If you deeply understand a company's business model, how much debt they have, and what their true competitive advantage is, a sudden drop in their stock price doesn't immediately trigger a panic attack. You can rationally step back and ask, is the business fundamentally failing, or is the market just throwing a tantrum right now? But if you bought in purely because of a cool story online, you have zero framework to make that call, and you're just left entirely at the mercy of your own fear.
All right, moving to habit number 3. JP Morgan did a massive 30-year study and found that missing just the 10 best trading days over 3 entire decades reduces your total returns by more than half. Think about that for a second. Decades of compounding wealth literally sliced by 50% just because you were sitting in cash on 10 specific random days.
And the secret to why this happens is that those massive, face-melting recovery days almost always cluster right around the absolute worst panic days. They happen right in the middle of extreme volatility. The top 10% have literally trained their brains to view market corrections as clearance sales, not the apocalypse. Because when the market tanks 30%, every human instinct screams at you to sell and stop the bleeding. But the winners know if you sell the dip, you're locking in your loss and practically guaranteeing you won't be holding the asset during those massive recovery days that always follow.
Section 3, the self-audit. Time to figure out which side you're actually on.
Okay, I want you to be brutally honest with yourself right now. Question 1. Are you constantly checking your portfolio? Are you voluntarily triggering that massive cognitive load? Because checking multiple times a day turns normal background market noise into intense personal emotional turmoil.
Question 2. In the last 12 months, did you buy into something based on a genuine, fundamental understanding of the asset? Or were you just chasing a narrative because your friends or the news wouldn't stop talking about it?
Question 3. Are you truly operating inside your circle of competence, or are you just holding on for dear life and hoping for the best? Seriously, if you can't articulate exactly why you own an asset in 3 simple sentences, you do not understand it well enough to be holding it.
And finally, do you actually have a mechanical system in place to protect your capital? Or are you sizing your positions entirely based on how confident you feel that day? Because if you don't have a strict sizing limit, you are walking a tightrope without a net.
Look, if you found yourself kind of nodding along to some of those 90% behaviors, and trust me, we've all been there, here is a really practical 5-step checklist to start building a system that actually removes emotion from the equation. Number 1, define your exit before you ever click buy. Number 2, lock your risk strictly to 1 or 2% per trade. 3, stick to what you know, your circle of competence. 4, step away from the daily charts and try checking just once a week. And 5, maybe most importantly, write down an actual investment policy for yourself right now while the market is calm. That way your rational, calm brain can take the wheel when the next crash hits and your emotional brain starts panicking.
This systematic, almost boring approach is honestly the only real difference between the winners and the losers. The 10% don't have some secret inside information, they just have a framework that makes panic impossible. So, I want to leave you with a final thought, and I'd love to hear your answers in the comments down below. Which of these 3 mistakes, buying the hype, overtrading, or having zero exit strategy, is your biggest vulnerability right now? Be honest, because identifying the weakness is the very first step to actually fixing it. Thanks so much for joining me for this explainer, and I can't wait to read your insights below.